Today we're diving deep into a strange beast of the investing world, the AMZY ETF. Now, this isn't your typical buy and hold play on a stock. AMZY uses a mysterious option strategy to target Amazon, AMZN, but with a twist. It focuses on income generation, not just stock price growth. Sounds interesting, right? But is it too good to be true? We'll crack open the AMZY mystery, explore how it works, and see if it fits your investment style. Stay tuned. What is YieldMax AMZN Option Income Strategy ETF AMZY? The YieldMax AMZN Option Income Strategy ETF AMZY is an actively managed exchange-traded fund ETF designed to generate monthly income for investors by selling, writing, call options on Amazon, AMZN, stock. Here's a breakdown of its key aspects. Investment objective. AMZY aims to provide investors with a combination of current income, achieved by selling call options on AMZN stock, which generates a premium upfront. Capped gains. The ETF allows participation in some of the potential price appreciation of AMZN, but with a limit due to the option strategy. Option strategy. AMZY utilizes a synthetic covered call strategy. Here's how it works. The ETF doesn't actually buy any AMZN shares directly. Instead, it sells, writes, call options on AMZN stock. These options give the buyer the right, but not the obligation, to purchase AMZN shares at a specific price, strike price, by a certain date, expiry. The premium received from selling these call options represents the income generated by AMZY. To hedge against a potential decline in AMZN's price, AMZY typically invests in cash and/or U.S. Treasuries with the proceeds from the option sales. Key considerations. Capped upside. If the price of AMZN stock rises above the strike price of the sold call options, the option buyer will likely exercise their right to purchase the shares from AMZY at the lower strike price. This limits AMZY's potential gains from significant price appreciation in AMZN. Income generation. The income stream from the premiums helps offset potential limitations on upside gains. However, this income depends on market volatility and AMZY's ability to consistently sell options. Management expertise. The success of AMZY relies heavily on the skill of the management team in selecting appropriate strike prices and expiry dates for the options contracts. Who should consider AMZY? Investors seeking regular income and a more conservative approach to benefiting from AMZN's growth, even if it's capped. Individuals comfortable with the active management style and potential limitations on upside, compared to directly owning AMZN stock. Important to remember. AMZY carries risks associated with option strategies, including potential for losses if AMZN's price falls significantly and the inability to capture full upside if the stock price soars. Fees associated with AMZY's management and operations can impact returns. AMZY might be suitable for a portion of a diversified portfolio. When was AMZY launched, and what was the stated objective for creating this ETF? AMZY was launched on July 24, 2023, according to various financial information sources like Yahoo Finance and GlobeNewsWire. The stated objective for creating the YieldMax AMZN Option Income Strategy ETF, AMZY, was to provide investors with a way to generate income. The primary goal was to offer investors a stream of income through the sale of call options on Amazon, AMZN, stock. These options contracts generate a premium upfront, which translates to income for AMZY shareholders. Benefit from AMZN's growth. With a cap, AMZY aimed to allow investors to participate in some of the potential price appreciation of AMZN stock. However, due to the option strategy employed, there's a limit to the upside gains investors can capture. Here's a deeper dive into the rationale behind AMZY's creation. Growth potential of AMZN. Many investors believe Amazon is a company with significant growth potential. AMZY offered a way to potentially benefit from this growth, even if it's capped, while also generating income. Alternative to buying AMZN stock, AMZY catered to investors who might be interested in exposure to AMZN but wanted a more conservative approach compared to directly owning the stock. This could be due to a desire for regular income. AMZY's option strategy aimed to provide a consistent income stream, which isn't the case with simply owning the stock. Hedging against downside risk. While AMZY doesn't completely eliminate downside risk, the use of cash and treasuries can offer some buffer compared to direct stock ownership. Catering to option-focused investors, AMZY provided a way for investors comfortable with option strategies to access this approach within the structure of an ETF. This offers advantages like diversification and potentially lower fees compared to individually managing options contracts. Does YieldMax have any other ETFs with similar option-based strategies? Yes, YieldMax offers several other ETFs that utilize similar option-based strategies to generate income for investors. Here's a breakdown. Focus. All YieldMax ETFs focus on selling, writing, call options on underlying assets, aiming to generate income from the premiums received. Variety of assets. While AMZY targets Amazon, AMZN, stock, YieldMax offers ETFs that use this strategy with various underlying assets, including other technology companies, broad market indices, and even single stocks outside the tech sector. Here are some examples of YieldMax ETFs with similar option-based strategies. Technology stocks. TSLY, YieldMax Tesla Option Income Strategy ETF focuses on Tesla, TSLA stock. OARK, YieldMax Innovation Option Income Strategy ETF targets a basket of innovative companies, potentially including technology stocks. APLY, YieldMax Apple Option Income Strategy ETF focuses on Apple AAPL stock. NVDY, YieldMax NVIDIA Option Income Strategy ETF focuses on NVIDIA, NVDA, stock. Other assets. XOMO, YieldMax ExxonMobil Option Income Strategy ETF focuses on ExxonMobil XOM stock, an example outside the technology sector. AMZY, YieldMax Universe Fund of Option Inc. ETF invests in a basket of options contracts across various sectors. Key points to consider. Each YieldMax ETF with an option-based strategy will have a specific underlying asset or basket of assets. Research each ETF to understand its focus. The performance and risk profile of each ETF can vary depending on the chosen option strategy and the underlying asset's volatility. Fees associated with each ETF might differ slightly. What is the specific option strategy employed by AMZY to generate income from Amazon, AMZN, stock? AMZY utilizes a synthetic covered call strategy to generate income from Amazon, AMZN, stock. Here's a breakdown of this strategy. What it doesn't do. Unlike a traditional covered call, AMZY doesn't directly buy any shares of AMZN stock. What it does do. 1. Selling call options. AMZY sells, writes, call options on AMZN stock. These call options grant the buyer the right, but not the obligation, to purchase AMZN shares at a predetermined price, strike price, by a specific expiry date. 2. Premium collection. When AMZY sells a call option, it receives a premium upfront. This premium represents the income generated by the strategy. 3. Hedging with cash/treasuries. The proceeds from selling call options are typically invested in cash and/or U.S. Treasuries. This aims to hedge against a potential decline in the price of AMZN stock. Understanding the mechanics. Strike price. The strike price of the call options sold by AMZY is typically set higher than the current market price of AMZN. This means the option buyer is unlikely to exercise the option immediately to purchase the shares from AMZY, since they can buy them cheaper in the market. Expiry date. AMZY might employ a rolling strategy for the options contracts. This means they might close out, buy back, options nearing expiry and sell new ones with a further out expiry date. This allows them to continue collecting premiums. Benefits and limitations of the strategy. Income generation. Selling call options provides a steady stream of income from the premiums received. Potential upside participation. If the price of AMZN stock stays below the strike price of the sold call options by expiry, AMZY keeps the premium and the underlying cash/treasury investment. Investors also benefit from some price appreciation up to the strike price. Capped gains. If the price of AMZN surges above the strike price, the option buyer is likely to exercise their right to purchase the shares from AMZY at the lower strike price. This limits AMZY's potential gains from significant stock price appreciation. Additional considerations. The specific details of the options contracts used by AMZY, such as strike prices and expiry dates, can vary depending on market conditions and the management team's strategy. This strategy relies on the ability to consistently sell call options and collect premiums. Market volatility can impact this ability. How does AMZY hedge its exposure to potential downside movements in the price of AMZN stock? AMZY's hedging against downside movements in AMZN's price is partial and relies on two main strategies. 1. Selling call options with higher strike prices. AMZY typically sells call options with strike prices above the current market price of AMZN stock. This means the option buyer is unlikely to exercise the option immediately to purchase the shares from AMZY at a higher price. As long as the stock price stays below the strike price by expiry, AMZY keeps the premium income and the underlying cash/treasury investment. This acts as a buffer if the stock price dips slightly. 2. Investing proceeds in cash and treasuries. The proceeds from selling call options are typically invested in cash and/or short-term U.S. Treasuries. These are considered relatively stable assets with low volatility. If the price of AMZN stock falls significantly, the cash and treasuries can help offset some of the losses. This provides some downside protection compared to directly owning AMZN stock. Limitations of the hedge. Limited downside protection. The hedge offered by cash and treasuries is limited. If the price of AMZN stock falls sharply, the gains from the options premiums might not be enough to fully offset the losses. Missed opportunity cost. Cash and treasuries generally offer lower returns compared to stocks. By investing a portion of the portfolio in these assets, AMZY potentially misses out on some of the potential upside if the stock market performs well. Additional considerations. The effectiveness of the hedge depends on the chosen strike prices and the volatility of the market. AMZY might use additional option strategies to further manage downside risk, but the details are likely not publicly available. How does AMZY's option strategy compare to other option-based ETFs targeting similar high-growth stocks? Here's a comparison of AMZY's option strategy with other option-based ETFs targeting high-growth stocks. Similarities. Income generation. All these ETFs aim to generate income by selling, writing, call options on underlying assets, typically high-growth stocks. The income comes from the premiums received upfront. Synthetic approach. Many option-based ETFs, like AMZY, employ a synthetic covered call strategy. They don't directly buy the underlying stock, but rather sell call options and invest the proceeds in cash or other assets. Potential differences. Underlying asset. While AMZY focuses on Amazon, AMZN, other ETFs target different high-growth stocks or even baskets of such stocks. This can lead to variations in risk and potential returns depending on the chosen stock's volatility and growth prospects. Strike prices and expiry dates. The specific strike prices and expiry dates chosen for the call options can differ between ETFs. This can impact the amount of premium income generated, the potential for upside participation, and the level of downside protection. Option rolling strategies. Some ETFs might use more aggressive option rolling strategies, frequently buying back and selling new options contracts. This can potentially generate higher income but also increase complexity and transaction costs. Management expertise. The success of these ETFs relies heavily on the skill of the management team in selecting appropriate option strategies for the chosen underlying assets. What are the primary risks associated with AMZY's option strategy, such as volatility or potential for missing out on significant upside gains in AMZN? AMZY's option strategy carries several inherent risks that investors should carefully consider before investing. Here's a breakdown of the primary ones. 1. Capped upside potential. Limited participation in AMZN's growth. AMZY sells call options with strike prices typically set above the current market price of AMZN stock. If the stock price soars above the strike price by expiry, the option buyer will likely exercise their right to purchase the shares from AMZY at the lower strike price. This caps the gains AMZY can capture from significant stock appreciation. Missing out on bull markets. In a strong bull market where AMZN stock price rises steadily, AMZY's capped gains due to the option strategy could underperform compared to directly owning the stock. 2. Volatility risks. Reduced income during downturns. While AMZY aims to generate income through option premiums, this income stream can be impacted by market volatility. If volatility drops significantly, investors might be willing to pay lower premiums for call options, reducing AMZY's income potential. Early assignment risk. In a scenario where AMZN stock price unexpectedly spikes towards the strike price, the option buyer might exercise their right to purchase the shares early. Assignment. This could force AMZY to buy AMZN shares at a higher price in the market to fulfill the obligation, potentially leading to losses. 3. Other potential risks. Management expertise. The success of AMZY hinges on the ability of the management team to effectively select strike prices, expiry dates, and potentially rolling option strategies. Poor choices can lead to lower income generation or unintended risks. Liquidity risk. AMZY itself needs to be a liquid investment for easy buying and selling. If the trading volume is low, investors might face difficulties entering or exiting their positions. Counterparty risk. Although the risk is considered low, there's a slight possibility that the counterparty to the option contracts might default on their obligations, impacting AMZY's returns. Mitigating these risks. Diversification, including AMZY as a part of a broader investment portfolio alongside other asset classes, can help mitigate some of the risks associated with its option strategy. Understanding the strategy. Investors should thoroughly understand the mechanics of AMZY's option strategy and its limitations before investing. Long-term perspective. AMZY might be suitable for investors with a long-term view who value a combination of income generation and some participation in AMZN's growth, even if capped. How does AMZY manage the risk of early assignment of sold options? AMZY employs a few strategies to manage the risk of early assignment of sold call options. 1. Strike price selection. Higher strike prices. A core strategy is selecting strike prices for the call options they sell that are above the current market price of AMZN stock. This makes it less likely for the option buyer to exercise the option early to purchase the shares from AMZY at a lower price. Balancing income and risk. While higher strike prices reduce the risk of early assignment, they also decrease the premium income generated from selling the options. AMZY needs to strike a balance between generating income and managing the risk of early assignment. 2. Monitoring and rolling strategies. Monitoring market conditions. AMZY's management team likely closely monitors the price of AMZN stock and overall market volatility. Rolling options. Potentially one strategy might involve rolling out the options contracts. This means buying back, closing, the near-expiry call options with a high risk of assignment and selling new call options with a further out expiry date and potentially a higher strike price. This allows AMZY to continue collecting premiums while potentially reducing the immediate risk of assignment. 3. Limited downside protection. Early assignment might not be all bad. In some scenarios, early assignment might not be entirely detrimental. If the stock price rises significantly towards the strike price and gets assigned early, AMZY captures some profit from the premium received when selling the option, even if they miss out on further upside potential. Limitations of early assignment risk management. Imperfect control. AMZY can't completely eliminate the risk of early assignment. If the stock price unexpectedly surges above the strike price, the option buyer might still choose to exercise early. Impact on income generation. Frequent rolling of options contracts can incur additional transaction costs, potentially reducing overall income generation. How does AMZY's expense ratio compare to other ETFs, and how do these fees impact potential returns? Here's a detailed explanation of AMZY's expense ratio compared to other ETFs and how fees impact potential returns. AMZY's expense ratio. Current ratio. According to sources like Yahoo Finance and Morningstar, AMZY's expense ratio is around 1.01% as of February 28, 2024. This represents the annual fees charged by the fund to cover its operating expenses. Comparison to other ETFs. Passive versus active management. Expense ratios can vary widely depending on the type of ETF. Passively managed index ETFs typically have lower expense ratios, often below 0.5%. This is because they simply track an underlying index and require minimal management. Actively managed option-based ETFs. AMZY falls under the category of actively managed ETFs employing option strategies. Option-based ETFs can have expense ratios ranging from 0.75% to 1.5% or even higher. This reflects the added complexity of managing the option strategies and the expertise required. Impact of fees on potential returns. Compounding effect. Expense ratios have a compounding effect on returns over time. A seemingly small fee like 1% can significantly reduce potential returns over a long investment horizon. Importance of lower fees. For income-focused strategies like AMZY, where the potential returns might be lower compared to growth-oriented investments, minimizing fees becomes even more crucial to maintaining attractive returns. How would a rising interest rate environment impact the returns generated by AMZY's option strategy? A rising interest rate environment can potentially have a mixed impact on the returns generated by AMZY's option strategy. Here's a breakdown of the potential effects. Potentially negative impacts. Reduced demand for option selling. When interest rates rise, investors might become more attracted to traditional fixed income investments like bonds, which offer potentially higher yields. This could lead to lower demand for purchasing call options, which AMZY sells, and potentially decrease the premium income generated by AMZY's strategy. Reduced stock market volatility. Rising interest rates can sometimes lead to a decrease in overall stock market volatility. While lower volatility might sound positive, for AMZY's strategy, it can be a double-edged sword. Lower volatility can also mean lower option premiums. Option prices are typically higher during periods of higher volatility. Potentially positive impacts. Hedging with cash and treasuries. A portion of AMZY's proceeds from selling options are typically invested in cash and/or short-term U.S. Treasuries. As interest rates rise, the yields on these holdings could also increase, potentially providing some additional income for AMZY. Overall impact. The net effect of rising interest rates on AMZY's returns is uncertain and depends on various factors. Magnitude of interest rate increase. A small rise in interest rates might have a limited impact, while a significant increase could have a more substantial effect. Market response. The overall market reaction to rising interest rates can play a role. If the stock market experiences a correction due to rising rates, it could further decrease AMZY's income generation through option premiums. Management strategy. The skill of AMZY's management team in adapting their option strategy to a changing interest rate environment can also influence the impact on returns. What is the underlying structure of AMZY? Is it a physically replicated ETF or a synthetic one? AMZY utilizes a synthetic structure to achieve its income generation strategy. Here's a breakdown of the key aspects. Physically replicated versus synthetic ETFs. Physical replication. In a physically replicated ETF, the fund directly holds the underlying assets that it tracks, e.g., stocks in an index ETF. The ETF might buy and sell these assets to reflect changes in the underlying index. Synthetic replication. In a synthetic ETF, the fund doesn't directly hold the underlying assets. Instead, it uses swaps or other derivative instruments to achieve a return similar to the target benchmark. AMZY structure. No direct ownership of AMZN stock. AMZY doesn't physically buy shares of Amazon, AMZN, stock. Focus on options and cash/treasuries. The core of AMZY's holdings consists of selling, writing, call options on AMZN stock to generate income from premiums. Investing the proceeds from selling options in cash and/or short-term U.S. Treasuries. These holdings act as a hedge against potential downside movements in AMZN's price. Benefits of synthetic structure for AMZY's strategy. Efficiency. The synthetic structure allows AMZY to achieve its income generation objective through options without needing to directly buy and manage AMZN shares. This can be more efficient from a management and cost perspective. Flexibility. The use of options contracts offers AMZY's management team more flexibility in tailoring the option strategy, strike prices, expiry dates, etc., to their investment goals. Considerations of synthetic structure. Counterparty risk. While typically low, there's a slight inherent risk that the counterparty to the swaps or other derivatives used in the synthetic structure might default on their obligations, impacting AMZY's returns. Transparency. The workings of synthetic ETFs can be slightly less transparent compared to physically replicated ETFs that directly hold the underlying assets. Does AMZY hold any additional assets, besides options contracts on AMZN stock? Yes, AMZY holds additional assets, besides options contracts on Amazon, AMZN, stock. Here's a breakdown of its typical holdings. Core holdings. Call options sold on AMZN. These are the primary assets used by AMZY to generate income through option premiums. The specific strike prices and expiry dates of these options contracts can vary depending on the management team's strategy. Cash and/or short-term U.S. Treasuries. The proceeds from selling call options are typically invested in these relatively stable and low volatility assets. This serves two purposes. Income generation. While offering lower returns compared to stocks, these holdings can generate some additional income through interest earned. Hedging downside risk. Cash and treasuries can provide some buffer against a potential decline in the price of AMZN stock. Potential additional holdings, less likely. Cash equivalents. In some cases, AMZY might hold other cash equivalent assets like money market funds to park the proceeds from option sales before investing them in treasuries. Derivatives. For advanced strategies it's less likely, but possible that AMZY's management utilizes additional derivative instruments *** beyond the core call options on AMZN. This could be done for more complex option strategies aiming to achieve specific risk-reward profiles. However, information about such holdings, if any, might not be readily available to the public. Here are some key points to remember. The vast majority of AMZY's holdings will be the sold call options on AMZN and cash/treasuries. These are the core components of its income generation strategy. Any additional holdings, like cash equivalents or other derivatives, would likely be a minor portion of the overall portfolio and used for specific purposes within the strategy. Transparency around the specific details of AMZY's holdings, particularly regarding any potential use of additional derivatives, might be limited. Investors should rely on the fund's official documentation for the most up-to-date information. How frequently does the option strategy employed by AMZY rebalance its holdings? The specific rebalancing frequency of AMZY's option strategy can vary depending on a few factors, but it likely involves a combination of option contract expiry. The core holdings of AMZY consist of selling, writing, call options on AMZN stock. These options contracts have specific expiry dates. As these expiry dates approach, AMZY will need to adjust its holdings. Management discretion. The management team has the flexibility to adjust the option strategy based on market conditions and their assessment of risk and potential returns. This might involve rolling options. This involves closing out, buying back, near-expiring call options, and selling new ones with further out expiry dates. This allows AMZY to continue collecting premiums while potentially adjusting strike prices or other aspects of the strategy. Adjusting cash/treasury allocation. The allocation between cash/treasuries and option contracts might be adjusted based on market volatility or the need for additional liquidity. Here's a breakdown of how these factors might influence rebalancing. Regular expiry dates. Many option contracts typically have expiry dates ranging from weekly to a few months out. As these dates approach, AMZY would need to take action, either rolling or closing out the options, to maintain its desired exposure. This suggests potential rebalancing activity at least every few weeks or months. Active management. The management team might choose to be more proactive and adjust the strategy more frequently than just at expiry. This could involve rolling options contracts even before they are near expiry, especially if market conditions change significantly. Challenges of pinpointing exact frequency. Limited public information. The specific details of AMZY's option strategy, including the exact expiry dates of the options contracts and the frequency of rolling them, might not be publicly available. Dynamic market conditions. The management team likely adapts their strategy based on real-time market conditions. This makes it difficult to pinpoint a single, fixed rebalancing frequency. What is the typical maturity of the options contracts used by AMZY? AMZY's option strategy typically utilizes call options with maturities ranging from 1 month to 1 year, with a focus on the shorter end of that spectrum. Here's a breakdown of the rationale behind this approach. Focus on income generation. AMZY seeks to generate income through premiums received from selling call options. Shorter-term options contracts, e.g., monthly expiry, generally offer higher option premiums compared to longer-term options. This is because shorter-term options experience faster time decay, which increases their price, premium, due to the higher risk of the option being exercised sooner. Balancing income and risk. While shorter-term options offer higher premiums, they also carry greater risk of early assignment. If the price of AMZN stock surges significantly towards the strike price before expiry, the option buyer might exercise their right to purchase the shares from AMZY early. This could limit AMZY's potential gains from significant stock price appreciation. Flexibility and management discretion. By using shorter-term options, AMZY maintains greater flexibility *** in its strategy. The management team can rebalance the portfolio more frequently by rolling out near-expiring options and selling new ones with potentially adjusted strike prices or expiry dates. This allows them to adapt the strategy to changing market conditions. Are there other ETFs that provide exposure to AMZN stock with a more traditional buy-and-hold approach? Yes, several exchange-traded funds (ETFs) offer exposure to Amazon, AMZN, stock with a more traditional buy-and-hold approach compared to AMZY's option-based strategy. Here are some examples. Broad market ETFs. SPDR SP500 ETF, SPY. This is a large-cap ETF that tracks the SP500 index. AMZN is a significant holding within the SPY portfolio, accounting for around 4% as of June 2024. Investing in SPY provides exposure to a basket of large U.S. companies, including AMZN, but with a focus on diversification and long-term growth. Invesco QQQ Trust, QQQ. This ETF tracks the NASDAQ 100 index, which includes 100 of the largest non-financial companies listed on the NASDAQ stock exchange. AMZN is also a holding within QQQ, and its weighting might be slightly higher compared to SPY due to the NASDAQ 100's focus on technology stocks. Technology sector ETFs. Vanguard Technology ETF, VGT. This ETF focuses on companies in the technology sector, and AMZN is a major holding within this ETF. VGT offers a more concentrated exposure to technology stocks compared to broad market ETFs like SPY or QQQ, but with higher potential risk and reward. Fidelity MSCI Information Technology Index ETF, FTSE. This ETF tracks an index of information technology companies globally, and AMZN is likely to be a significant holding. FTSE offers a broader exposure to technology companies compared to VGT, which focuses on U.S. companies only. Key differences. Investment strategy. These ETFs directly purchase and hold shares of AMZN and other companies in their underlying index. This contrasts with AMZY's strategy of selling options and holding cash/treasuries. Risk and return. These ETFs aim for capital appreciation through long-term growth of the companies they hold. Their performance is directly tied to the stock price of AMZN and other holdings. AMZY, on the other hand, focuses on income generation through option premiums, with potentially capped upside participation in AMZN's growth. Fees. Expense ratios of these ETFs might be slightly lower compared to AMZY due to the simpler structure of a buy-and-hold approach. Choosing the right ETF. The choice between an ETF like AMZY and a traditional buy-and-hold option depends on your investment goals and risk tolerance. Income generation. If your primary goal is generating income, AMZY might be suitable. However, consider the potential limitations on upside participation and the risks associated with options strategies. Long-term growth. For long-term capital appreciation with exposure to AMZN, a broad market ETF like SPY or a technology sector ETF like VGT might be a better fit. Risk tolerance. Traditional buy-and-hold ETFs can be more volatile than AMZY's option strategy, but they also offer potentially higher long-term returns. How do the expense ratios and risk profiles of these alternative AMZN-focused ETFs compare to AMZY? Here's a breakdown of how the expense ratios and risk profiles of alternative AMZN-focused ETFs compare to AMZY. Expense ratios. AMZY, around 1.01% as of February 28, 2024. This reflects the additional complexity of managing an option-based strategy. Traditional buy-and-hold ETFs, expense ratios for these ETFs are typically lower, often below 0.5%. This is because they employ a simpler strategy of passively tracking an underlying index. Risk profiles. AMZY. Lower volatility. AMZY's option strategy with a focus on cash/treasuries can offer lower volatility compared to directly owning AMZN stock. This is because the option premiums help hedge against some downside movements in the stock price. Capped upside potential. However, AMZY's strategy also caps the potential upside ** from significant growth in AMZN stock price. Investors forego some potential gains in exchange for the income generated from option premiums. Risk of early assignment. There's a risk of AMZY being forced to buy AMZN shares at a higher price ** if the option buyer exercises early assignment. Counterparty risk. Although low, there's a slight chance ** the counterparty to AMZY's options contracts could default. Traditional buy-and-hold ETFs. Higher volatility. These ETFs are directly exposed to the stock market's volatility, including fluctuations in AMZN stock price. This can lead to higher potential returns, but also higher potential losses. Uncapped upside potential. Investors benefit from the full potential upside if AMZN stock price appreciates significantly. No early assignment risk. Investors are not exposed to the risk of early assignment like in AMZY's strategy. Lower counterparty risk. Typically considered lower compared to AMZY since these ETFs directly hold the underlying stocks. Choosing the right option. The best choice between AMZY and traditional buy-and-hold ETFs depends on your investment goals and risk tolerance. Income generation. If your primary goal is generating income, AMZY might be suitable despite the capped upside and potential risks. Long-term growth. For long-term capital appreciation with the potential for higher returns, traditional buy-and-hold ETFs might be a better choice, even with the higher potential for volatility and losses. Risk tolerance. Consider your risk tolerance. AMZY offers lower volatility but capped gains, while traditional ETFs offer the potential for higher returns, but with higher risk. Could a custom option strategy be replicated using individual options contracts on AMZN to potentially achieve similar results with lower fees? Yes, it is possible to attempt to replicate a similar strategy to AMZY's using individual options contracts on AMZN. However, there are significant considerations and potential drawbacks to keep in mind. Feasibility of replication. Core strategy. The core of AMZY's strategy likely involves selling, writing, call options on AMZN with specific strike prices and expiry dates. You could attempt to replicate this by selecting similar option contracts. Active management. Replicating the more nuanced aspects of AMZY's strategy, including frequent rolling of options and potentially using more complex option combinations, would be difficult and time-consuming for an individual investor. AMZY's management team has the resources and expertise to actively monitor and adjust the strategy as needed. Potential benefits of a custom strategy. Lower fees. By eliminating the expense ratio associated with AMZY, you could potentially achieve higher returns if the custom strategy performs similarly. Challenges and drawbacks. Transaction costs. Frequent buying and selling of individual options contracts can incur higher transaction costs compared to holding an ETF like AMZY. These costs can eat into your potential returns. Time commitment and expertise. Successfully replicating AMZY's strategy requires significant time and options trading expertise. You'll need to actively monitor market conditions, assess risks, and make informed decisions about option selection and rolling strategies. Mistakes in options trading can lead to substantial losses. Limited liquidity, especially for options contracts with less common strike prices or expiry dates, liquidity might be lower compared to the options held by AMZY. This could make it difficult to enter and exit positions at your desired prices. Margin requirements. Selling, writing, uncovered call options might require maintaining a margin ** account with your broker. This means putting up a certain amount of cash as collateral to cover potential losses. Alternatives to consider. Less complex option strategies. If the goal is income generation, you could explore simpler option strategies using individual options contracts. However, these might not perfectly replicate AMZY's approach and could involve different risk-reward profiles. AMZY as part of a diversified portfolio. Consider including AMZY in your portfolio alongside other investments for a balance of income generation and potential growth. This approach allows you to benefit from AMZY's expertise while potentially mitigating some of the risks. How would incorporating AMZY into a broader portfolio strategy alongside other asset classes impact overall portfolio risk and return? Incorporating AMZY into a broader portfolio strategy alongside other asset classes can potentially improve risk-adjusted returns by achieving diversification benefits. Here's a breakdown of the impacts on risk and return. AMZY's risk-return profile. Lower volatility. AMZY's option strategy with a focus on cash/treasuries can offer lower volatility compared to stocks like AMZN. Income generation. AMZY aims to generate income through option premiums, offering a potential income stream ** to the portfolio. Tapped upside potential. AMZY forgoes some potential upside growth from AMZN stock price appreciation. Impact on portfolio risk. Diversification. By adding AMZY to a portfolio with other asset classes, e.g., bonds, international stocks, you can potentially reduce overall portfolio volatility. This is because these asset classes might have negative correlations with AMZY's performance, meaning they might move in opposite directions, helping to offset losses in one asset class with gains in another. Reduced portfolio drawdown. The lower volatility of AMZY can potentially reduce the depth of potential portfolio drawdowns during market downturns. This can help improve risk-adjusted returns, even if the overall return potential might be slightly lower compared to a portfolio with only high-growth assets. Impact on portfolio return. Income generation. AMZY's income stream from option premiums can contribute to overall portfolio return. This can be particularly valuable in low-interest rate environments where traditional fixed-income investments might offer lower yields. Potential for growth. While AMZY's upside from AMZN's growth is capped, some participation is still possible. Additionally, other asset classes in the portfolio can contribute to potential capital appreciation. What is the liquidity of AMZY compared to other ETFs? AMZY's liquidity can vary compared to other ETFs, depending on several factors. Potential advantages. Underlying assets. AMZY invests in a widely traded stock, AMZN, through options contracts. This suggests there should be underlying liquidity to support the buying and selling of AMZY itself. ETF structure. ETFs are typically designed to be liquid investment vehicles. Authorized participants, large institutions, can create and redeem creation units of the ETF with the underlying basket of assets. This process helps maintain liquidity for ETF shares on the exchange. Potential disadvantages. Option-based strategy. Unlike traditional ETFs that directly hold the underlying stocks, AMZY relies on option contracts. The liquidity of specific option contracts can vary depending on factors like strike price, expiry date, and overall market conditions. Less common option contracts might have lower liquidity. Trading volume. Compared to broad market ETFs or ETFs tracking very popular stocks, AMZY might have a lower daily trading volume. This could potentially impact the tightness of bid-ask spreads and the ease of entering and exiting positions at your desired prices. How AMZY liquidity compares. Broad market ETFs, large, well-established ETFs tracking major indexes, e.g., SPY, QQQ, typically have very high liquidity. Sector ETFs, ETFs focused on specific sectors, e.g., VGT for technology, generally have good liquidity, but it might be lower compared to broad market ETFs. Less popular ETFs, ETFs with lower investment focus or smaller asset bases might have lower liquidity, potentially impacting bid-ask spreads and trading ease. How does AMZY handle potential changes in the options market or regulatory environment? AMZY's option-based strategy needs to be adaptable to fluctuations in the options market and potential shifts in the regulatory environment. Here's how AMZY might handle these challenges. Options market fluctuations. Volatility. Changes in implied volatility, which reflects the market's perception of future price movements, can impact the premiums received from selling options. AMZY's management team might adjust strike prices. They could adjust the strike prices of the options they sell to better reflect the current volatility levels. Change option types. In some cases, they might switch between selling covered calls, where they own the underlying stock, and naked calls, where they don't, depending on their risk assessment and the volatility environment. Liquidity. Lower liquidity for specific option contracts can make it difficult to enter and exit positions efficiently. AMZY might focus on more liquid options. The management team might prioritize option contracts with higher trading volume to ensure easier portfolio adjustments. Adjust portfolio allocation. They could potentially allocate a larger portion of the portfolio to cash/treasuries if option market liquidity deteriorates significantly. Regulatory changes. Margin requirements. Regulators might adjust margin requirements for option trading. AMZY might need to adjust its leverage if these requirements become more stringent. Restrictions on option strategies. In a less likely scenario, regulators might impose restrictions on certain option strategies. AMZY would need to adapt its approach to comply with any new regulations. AMZY's advantages in adapting. Active management. AMZY benefits from active management by a team of professionals who can monitor market conditions and adjust the strategy as needed. Flexibility. The inherent flexibility of option-based strategies allows AMZY to adapt to changing market dynamics by modifying strike prices, expiry dates, or even the types of options used. Challenges and considerations. Predicting market changes. Accurately predicting future market movements and regulatory changes is difficult. AMZY's management team needs to be proactive *** in monitoring the environment and adapting accordingly. Performance impact. Adapting the strategy to changing conditions might impact AMZY's performance in the short term. However, the goal is to maintain a sustainable income generation approach over the long term. Alright, so we've unpacked a lot about AMZY. There's definitely some potential for income generation and lower volatility compared to just buying AMZN stock. But remember, it's not a free lunch. Replicating AMZY's strategy yourself can be complex and time-consuming. The lower fees might be offset by transaction costs and the challenges of managing options. The good news? AMZY can fit into a broader portfolio strategy. It can add a layer of income and potentially reduce overall risk. But the weight you give it depends on your goals and risk tolerance. So, is AMZY right for you? Well, that depends. Do your research, consider your investment horizon, and weigh the risks and rewards before diving in. Thanks for joining us today. If you enjoyed this video, don't forget to like and subscribe for more in-depth investment explorations. See you next time.